You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to the show, everyone. As always, on the Wednesdays, we now do this show with Zulfi Ali of Volatility Wealth. Zulfi, welcome to the show.
Great to be back again, Buck.
As a reminder, Volatility Wealth is effectively a type of private, what do you call it, sort of a family office for the high-paid professional. For those who really aren't in that sort of, ultra-high net worth category, but who are making a decent amount of money, making several $100,000 a year, maybe you're making $1 million a year. That's still not usually where you get a family office. That's where Volatility Wealth comes in, help you button everything up. Speaking of buttoning things up, part of the button process relates to last week's podcast, Zulfi, and we spoke about, I interviewed somebody on the topic of asset protection. Do you have any commentary there?
Nothing additional to add. I would only reiterate that, asset protection, along with estate planning, along with tax mitigation, all of that really is a comprehensive approach that needs to be utilized when you're making decisions and planning out your own wealth strategy. So I think everyone should be familiar with it. I really like listening to those shows, despite the fact that some of that information is repeated over and over, because you should just be thinking about it constantly. You should be, always looking for ways to improve your situation. And as your financial position and situation changes, you have different, bells and whistles that you need to be thinking about adopting along the way. So I thought it was a useful reminder on that topic.
Yeah, and I know there are some differences with regard to philosophies. I use Doug Lodmell. I know you guys have been working with Doug as well as part of that advisory. Is that right?
Yep, that's right.
Yeah, so Doug's a good guy, very useful, and you can generally, you can always get a free consultation with Doug. But again, if you're coming at this from a holistic standpoint, like for example, even at the beginning of that podcast, I talked about sort of the intricacies between estate planning and asset protection. Those are things that are become increasingly more and more difficult to keep track of. So it's nice to have a quarterback where Volatility Wealth can come in for that. Now let's talk. Let's shift a little bit. Talk a little bit about the market since last week. What's new?
Well, there's been some volatility in the markets. We've had a few economic reports come out. So some of the data came out. One was the core PCE Price Index. And so that's a good inflation tracker. And that came in line with expectations, which was just a very slight increase, 0.2% year over year for the month of April. And that's the core PCE. Which excludes food and energy. If you include the food and energy impact, then it rose by 0.3%. So again, very negligible. And annual inflation, if you're using the kind of monthly numbers, it would be implied around somewhere in the mid 2% level. So I think we're getting there, and I think this is what the Fed has been kind of holding off and waiting for.
Okay, what's the difference? What's the difference between the core PCE price index and the CPI, which we've been referencing as well?
Yeah, it's just a different index. So one is the PCE is a personal consumption and expenditure index. And then PCI has just got a different basket of goods. It comes out in a different timing. So they're both pretty close.
Do the Fed pays more attention to the core PCE, you were saying?
They like the core PCE because they like to exclude the food and energy components in the measurements. Food and energy tend to be more volatile, and energy in particular is something that the Fed really doesn't have any control over, right? Energy prices. So it doesn't make much sense for them to be looking at those types of inputs into the data. So they take those out, and then everything else stays in. So that's what they like to look at, and they're kind of fixed on that.
What was it last month?
Last month, I think core PCE rose right around 0.3 or 0.4 again.
So a little bit higher than this month. So again, suggesting potentially some
directionally it's coming where we want it to go. Ideally it'll head down to very, very low levels, maybe even 0.1 increase, something like that. Directionally, it is doing what it's supposed to. The other report that we got Tuesday this week was the job openings report. And remember, job openings and the labor market, are very important right now because that's the piece that seems to stay quite strong. I
Right.
think the Fed is concerned about increasing labor costs and that sort of thing. And what we
Mm-hmm.
saw now is April showed a decrease versus March. And not only that, but April job openings are now at the lowest level since February of 2021. So that's a few years of higher than current labor
So basically,
market.
they're
So
not hiring as much,
there,
fewer companies, and that's suggesting basically that these companies are not anticipating the need for.
what it means is that that's a deceleration, right?
Mm-hmm.
And this is actually a decrease. So the numbers are still positive. They're like 800 something thousand jobs openings, but that number is decreasing for the first time and getting at a level where it's below a multi-year kind of level. So again, just showing that it's heading in the right directions because
Right.
the labor market was putting a lot of pressure, and that has a tendency to cause other inflationary things to blow out of proportion in the future. So based on that, markets have been a little choppy. I was a little surprised that we saw some of the volatility that we did over the last week. I think most of the major indices are down on the equity side by a couple of percent, so 1 or 2% across the board. We saw other asset classes kind of some up, some down. Gold is down a bit. Bitcoin, I think, is rallying back up to 70,000 level and higher.
Yep.
So I think what you're going to see over the course of the summer, Buck, is that you're going to have ongoing volatility. We're going to just kind of be looking at the numbers. The market's going to keep looking at numbers. They're going to go up. Sometimes they're going to go down. Sometimes I think we're going to stay in a pretty tight range, but a couple percent up, couple percent down. We've got the elections coming up in November, obviously. There's a lot of policy implications, and I don't think those are baked in yet just because there's too much uncertainty. We don't know who's going to be elected. We don't know which parties are going to control Congress. So things like tax, tariffs, fiscal policy, all of that, it's really hard for the market to price in right now.
I'm just thinking about what happens in October. And I'm like, if you look at the trends here, and I'm bringing up October because it's the month before the election.
Yeah.
And if the jobs stuff keeps in the same direction, we've already talked about like what's happening in the rent department and how that will almost certainly affect CPI and I guess PCE in this case as well.
Mm-hmm.
You can just see a scenario where like October just looks like a really, really bad economy.
Right. It could. I mean, and there's a risk that that economic conditions,
right,
accelerate to the downside too, because the things that you're saying are exactly right. We know that there are trailing numbers that aren't baked in at the level that they should be, right? So all of a sudden you could see those taking things down naturally. Mm-hmm. And then you can see on top of that, if there was any sudden, movements in some of the other data points, that all of a sudden it could look bad. It could look.
The other thing is that in those months that precede elections, I don't remember the statistics on this, but there's always a natural slowing of the economy. A lot less decisions are made by decision makers and businesses, and therefore, you're going to see generally a little bit of slowing. Do you know any of that statistics off the top of your head, or at least be able to confirm what I'm saying?
No, I think you're generally right. I mean, most companies, approve their spending and CapEx budgets earlier on the year. That gets deployed by the time you're heading into October, November, and that sort of thing. It's end of year, so it's the companies are typically not refreshing their budgets. They're just now focused on meeting the numbers for the year end, right? So I think that is the case. You don't usually see a huge upcycle, even in hiring, right? You don't typically see a lot of companies hiring towards the latter part of the year. So I think that could continue to come down,
especially election years. I mean, that's just what I'm getting at.
Yeah, I think especially election years. You're absolutely right about that.
You mentioned some volatility in the market. So what's going on with public trading markets, and then maybe we shift into real estate from there?
Yeah. So as I said, there's a little bit of volatility, but generally, I think if the economy gradually slows and inflation numbers continue to, become more, contained, then I think you do have a very good backdrop, as you head into the second half of the year for stable market conditions. I do think that if the economy cools a bit more than expected, you then start running into challenges with the equity markets because the equity markets are assuming almost what we call a Goldilocks scenario, where it's a very soft landing.
Mm,
The economy is still growing, but yet the inflation numbers come down, and then we're reaccelerating into a stronger economy. So that's a really tough needle to thread. I think at this point, bonds are probably looking like a little safer place in the sense that if the economy does go softer than we're expecting, bonds will probably rally quite a bit because that means interest rates will go down more than we're expecting, which
right.
means existing bond prices go up. So you make more money on that.
How about real estate?
Yeah, real estate. I like real estate because it's a real asset. So longer term, if we stay in an inflationary environment, the asset itself will go the right direction. It's typically purchased with leverage. So again, I think we talked about this before. It's good to have some debt in an environment where interest rates are higher. But then on the flip side, if you have an environment where the interest rates come down, you will see that the financing ability for acquirers of real estate is back, right? And then prices go back up from that perspective. So I think real estate's kind of a nice sweet spot, and I really like I really like the timing with
Yeah.
respect to investing in real
I
estate
mean,
now.
basically I think we're starting to see a little bit more movement. We started underwriting on some deals. There's a little bit more liquidity in the market, which is probably one of the biggest problems. Is there just was not there just wasn't very many buyers or sellers, and so I think there's more of that. So that's going to be helpful. But I think what you're talking about with interest rates coming down is a really important point because you know what, interest rates are going up was the reason why these a lot of properties lost value, right? Because capitalization rates in real estate go up with interest rates. Obviously, there's always you got to be very careful with floating debt, as many have seen in this market. But it really raises a question of whether you would fix debt or float debt in this market when in my opinion, you're almost certain to see rates go down.
Yeah.
Then you're getting stuck with rates that are much higher. I'm just curious on your take on that.
No, I tend to agree with that, Buck. I think that most of the smart operators in this environment will be looking to have at least partial floating, if not fully floating
Yeah.
debt. I mean, obviously, there was an environment where interest rates were extremely low. That was the time actually people should have been fixing their debt because chances are it was going to go up from there, right? So,
Yeah.
so it's a little counterintuitive when you're out there doing these deals, but that's exactly the way to think about it when you're in a higher environment
Yeah. The,
with respect to rates. Yeah.
the only challenge, and I think, people are probably wondering, well, why didn't everybody fix rates? And the reason is that in short term, what happens with, especially in value add real estate, is that if you do the fixed debt, that's usually going to come from Freddie Fannie debt. And you don't get, you get these massive prepayment penalties. And so usually if the business plan is like a 2-year or 3-year business plan, you're not going to fix debt because you're just going to pretty much, the prepayment penalty would pretty much eat into all of your profits. And so that is, unfortunately, I think that's where a lot of people a lot of operators got caught. But in the situation now, it's sort of like, well, gosh, rates are high. They're going to go low. So if you're worried about them temporarily going higher, I guess you get, you rate cap insurance for a few years. One thing's for sure, it is a good time to buy real estate because the value of real estate will go up in a descending rate environment. So,
Yeah. Absolutely.
One last question on just as it relates to all these indicators going down. At what point does the Fed have to like not do anything because the election's coming up, right? I mean, so all of a sudden the indicators start getting worse and worse, and all of a sudden, say CPI or PCE actually drops, more than they think it's going to, and they get freaked out. But you're only 2 or 3 months away from an election. Can they do anything at that point? Would they do anything?
I mean, yeah, theoretically they can. I guess I take the view that the Fed just does not want to get in the front of any politics, and so it would probably just want to lay low and quiet and out of the picture when you've got the major election activity underway. And I think by major election activity, I would include the parties and all the stuff that's going to start picking up in July timeframe, June and July timeframe, with the national conventions and stuff like that. So my own view, this is personal, I think the Fed is pretty much not got any more time left now, because they've got a couple more meetings before elections. I don't think they're going to do anything before that. That's probably going to be pushed till end of the year.
Yeah. But treasuries will change though, right? I mean, there's nothing stopping the treasuries.
Treasuries change based on market trading,
right.
And the markets will trade and reflect their forecast for the economy on an instantaneous basis.
So mortgage rates are going to reflect what's going on one way or another.
Yeah, we've seen mortgage rates, fluctuate quite a bit, despite the fact that the Fed has held firm at its, 5.25 Fed rates for several years now. So yeah, absolutely.
All right. Last part of this program we've been doing, we actually started it by accident last week when I asked you what, can't even remember what it was, but I was asking you, what junk bonds.
High yield bonds.
I was asking you about, and you called them high yield. I called them junk bonds, but I don't know anything about them. But now I do. But this week we're going to talk about another topic, which is private credit funds. So obviously something that you guys through Volatility Wealth must offer. What are they exactly?
Again, they're and I'm glad you brought up the topic of junk bonds last week. So I think it's good to discuss these different types of investments, different asset classes that investors can look at when they're constructing their investment portfolios, and we certainly do that at Volatility Wealth. We're looking at a variety of different asset classes. We put them together to create a portfolio that makes sense for the investor. So high yield bonds, or junk bonds, as I mentioned, were one component of that. Private credit funds are also very interesting these days. In particular, what's happened is that traditional banks have been pulling out of a lot of private situations where they're not lending as much to private businesses. They're more risk averse. So the opportunities, they're leaving behind opportunities on various things like credit card debt, business loans, personal loans, real estate loans, all that kind of stuff. So what's happened as a result is that a lot of the private sector or the non-bank sector has gotten involved. And typically that's in the form of putting together a fund. So like you might have a private equity fund that invests in the equity of private companies. A private credit fund is essentially a fund that is going to lend or extend credit to companies or purchase debt from the market. So it might purchase, again, credit card debt, business debt, private loans, that sort of thing.
That sounds
including real estate loans, by the way.
Okay, interesting. So they're sort of packaged up into products that you can buy, sort of as
they're packaged up in the fund. So a fund will have a very specific strategy typically. So they'll have a focus area, and then they can target different debt structures. Some of them might extend just straight loans like cash flow loans. Others might be asset-backed loans. You might have distressed debt funds, which are particularly of interest these days. You might have subordinated debt funds. So depending on your risk profile, depending on your desire to achieve return, you can find a credit fund that meets your needs.
What's the
basically.
typical, I mean, like when you look at these things, I mean, people obviously want to know, like, oh, what kind of returns you can get on those.
Yeah, so the credit funds are typically structured to yield anywhere from kind of 8 to 12% annualized cash returns, and they are they're again a good vehicle for diversification. They generate a cash return, so it is a debt instrument, as if you were buying a bond or whatnot, where really what you're trying to get is the yield, right? You're trying to pick up the yield, and then you'll get your investment at the end. There's not an equity return per se.
Is there what's the risk element in these things? I mean, like, obviously, if you're talking about with the junk bonds or high yield bonds that you talked about before, I mean, those are still like B-rated companies, that kind of thing, that people are buying their stock left and right without even thinking about it, right?
That's absolutely right. Yeah. Well, so credit funds, you're going to have the whole full spectrum of risk. You can get very high risk. You can get much low risk. So there's it really depends on the strategy of the fund itself, and they tend to, for example, when they're exposed to individuals as their borrowers, whether that's through, say, credit card debt or loans and that sort of stuff, they tend to be very well diversified. So they will have thousands and thousands of these loans out to individuals. So any one or two borrowers can default, and it doesn't really affect the fund much. But as you get larger default rates, that can be significant. So again, you can find credit funds that are as safe as even investment grade type of funds, but there you're not going to get the same type of return. So it's a trade-off as usual.
And again, you don't buy these things off the like, they're not publicly traded things.
They are not. You have to find a manager that you trust. Fund manager selection is key. So just like as if you were going to buy, become an LP in a private equity fund or a real estate syndication, this is the same way. There's a fund manager that is a specialist in what they do in terms of, originating these types of loans, in terms of servicing them, managing them, all of that kind of stuff. And so you want to make sure that you get the right fund manager. And again, that's something that we do from Valerity Wealth. We'll identify the right fund manager.
Sounds good. Well, I think we got a nice update for the week. Sounds like, net things are headed in the right direction. From the real estate side, I feel like there's some potential opportunities that hopefully people will be open to, because I think it's a tricky time in the markets. We're seeing a lot of blood and gore and all that. It's hard to get in there and actually buy, but that is when people make money. So again, Valerity Wealth is a wealth management. Would you call it a wealth management firm?
We are a registered investment advisor.
A registered investment advisor.
We work with our investors similar to like providing family office services, basically, full end to end.
Right. And it's Valerity, VELERITY, wealth.com. Free consultation. Right?
Yep. Absolutely.
Fantastic.
You can reach me on the website. There's a contact form, and I'll get right back to you.
Great. Zulfi, thanks for joining us. And again, if anybody is interested in having somebody be the quarterback of their wealth as you created without necessarily having to have your own family office, check out valeritywealth.com.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.